Hey everyone. In follow-up to last week's video where I focused on commercial real estate delinquencies and the risk they pose to the banking system, some additional information just came out. I came across some newly released commercial real estate foreclosure data, and the Mortgage Bankers Association just updated their loan maturity information. While neither of these data updates materially changed my perspective on whether commercial real estate poses a risk to the banking system, which I think is overblown, the new information does add some color to the conversation. I'll start with the foreclosure data. According to the data provider Adam, there was a sharp upswing in commercial real estate property foreclosures. The count was nearly double the same month last year, with 635 commercial real estate foreclosure filings in January. On the surface, that's a big jump, and the rate of increase does raise some concerns. But we have to consider that between 2014 and 2019, what I characterize as the normal years for commercial real estate, there was an average of nearly 500 foreclosures per month. So, 635 properties entering foreclosure in a month doesn't seem so extreme. It's also worth noting that since the onset of COVID in April 2020, the number of properties entering foreclosure was down significantly. The average number of foreclosures between April of 2020 and the end of 2022 was just 255 per month. Since then, the number has been climbing steadily. I think the foreclosure downturn was partially driven by COVID-related policies that temporarily reduced foreclosure risk. And now we're seeing some of the deferred foreclosures show up. But I also suspect that many of the foreclosures are in the hardest hit property segment, older urban office buildings. And that segment poses the greatest risk of foreclosures going forward. Meanwhile, foreclosures in highly sought after properties like industrial, apartments, self-storage, and well-located retail will be very limited. Now, as for the other data that came out, I mentioned last week that new FDIC guidance empowers banks to offer commercial real estate borrowers extensions and other workout options at their discretion. And the new data from the Mortgage Bankers Association gives some insights into how much of the $728 billion of debt that was supposed to mature in 2023 was pushed back. Compared to what was reported last year, the total debt maturing in 2024 increased by $270 billion. Maturities in 2025 increased by $34 billion, and the 2026 total rose by $75 billion. No one that I know of has the exact numbers on how much of the new balances are deferred versus new loans, but it's likely the vast majority of the increase, at least in 2024, is deferred debt. So, just using rough math, somewhere between $300 and $500 billion of last year's maturing debt was likely deferred. Office property debt maturing in 2024 had the greatest increase, rising by $89 billion to a total of $206 billion. Industrial was next with a $48 billion gain to a new total of $110 billion, followed by a $45 billion gain in the 2024 hotel maturities. Retail debt maturing in 2024 only went up by $8 billion, and multifamily increased by just $2 billion. So it looks like the loan extension model that was so effective during the global financial crisis and the health crisis is being put to use. How effective it will be in averting a significant wave of distress will likely depend on three major factors. First, what happens with the economy this year? Whether we achieve a soft landing, and how the economy and inflation impact rate decisions by the Federal Reserve. Second, what happens with interest rates this year? Whether they go down, how much they go down, and when they go down. And finally, how the real estate market performs. What happens with sales velocity, the expectation gap, and pricing. Office properties have one other variable: whether employees return to the office in greater numbers. Now, as I said at the beginning of this video, the new data doesn't change my perspective on the risk commercial real estate poses to the banking system. I still think the risk is low. Obviously, some commercial real estate will face distress and there will be some foreclosures, but I think we'll see a ripple, not a tsunami. And the banking system will probably be just fine. As new data emerges, we'll all continue to refine our insights and perspective. That's why we need to keep tracking all the new information that comes out. And of course, we all need to keep our eyes on the horizon.